Exxon Mobil issuing new financial guidance yesterday, assuring Wall Street at its annual investor meeting that the oil giant's potential for profit and cash flow looked better than it was a year ago. I spoke to the CEO, Darren Woods, about the message that he had for investors.
What was probably the most exciting discussion we had, though, was the upside that we've identified over the course of last year to improve upon that base plan that we put out last year. And that's $4 billion of additional CapEx from 2019 to 2025.
Okay.
And with that $4 billion of CapEx comes an additional $40 billion of NPV over that same time frame, $9 billion of cumulative earnings over that same time frame, and $24 billion of cumulative cash flow over that same time frame. And so very productive incremental capital on the base that we laid out last year for this plan to double and triple our earnings across our different sectors.
I understand your long-term planning for this, and it does sound like you are planning for the long haul, but the knee-jerk reaction on the street today has been that the stock is traded down. I think it was down about 1.7% the last I just checked. And from analysts who are saying anything about this, they say, you know, they were looking for potentially more information on share buybacks and maybe more return of capital to shareholders. What would you say to them on that?
For our business to be successful over any of those time frames, you got to have productive, accretive, value accretive investments. We're in a depletion business, so every year, if you're not investing to keep your business whole, you're attriting. And so that's a really important part of the business that we've got to basically continue to establish good investments as we go, through time, as the business continues the natural depletion of our resources. So the projects that we put into the portfolio have very good returns, are accretive, and are advantaged versus the rest of competition. What happened when the prices came off in 2014, a lot of industry pulled back.
Right.
That's when we leaned in, found these opportunities, and now we're progressing those. I think in terms of short-term prices, the market tends to move quite a bit on any one day. I think the market in general is down. What we've found over time as we're talking to investors is they like the plan. One of the things we added this year was additional investments. So as we've loaded our upstream project pipeline, it's given us opportunity to work the existing inventory. So what we talked about today is a divestment program, $15 billion, which is a risked divestment program, and our expectation is that as that begins to mature and materialize, that would go back into share buybacks. And
so that is part of the plan. As the assets are divested, you're going to be looking at this too.
Because if you look at our base business, as our first priority is the investment in the assets. We've got a balance sheet that allows us to continue to do that, and so we've looked at kind of our balance sheet, our objectives to grow dividends, keep a reliable and growing dividend, and then maintain a strong balance sheet. We can do all that in a pretty wide array of price environments, so the additional money coming in from divestments we can use for share buybacks.
The areas that you're looking to add include places like the Permian Basin. That's been a big place, and you also announced today that you're going to be stepping up production there pretty drastically, up 80% over what you had told us a year ago?
That's right.
That's an important area because it's a highly profitable area. What's the price that you can be returning investment, a double-digit return on investment? $35
so we
said,
we're said below $35 we're going to be profitable. I think the big change from last year is as we brought that asset into our portfolio, that was an acquisition that we brought in, we kind of took it into the Exxon Mobil kind of machine as we talked about it today and said, how do you, if you step back and think about unconventional development, how does Exxon Mobil, with all the advantages and the resources we have, bring that to bear in unconventional development? And the plan that we took people through today is basically the Exxon Mobil advantages being applied at scale to the unconventional, which has given us the growth.
Well, that's what I was going to ask you about. Chevron also has made some comments on this. They've also been investing heavily in the Permian Basin, and the CEO there said that this really is a scale game. It's not going to be for small players, that you have to have the scale to really be able to make this make sense. Would you agree with that? Is that what this
Well,
game
I think
is
there
about?
are opportunities for scale, no doubt about that. And it's also a function of what kind of acreage you have, how contiguous that acreage is. The acquisition that we made allowed us to approach this at scale, and so we have a very large blocks, long corridors where we can develop them like a large project, and that brings the advantage.
Where are you going to be putting the additional CapEx that you talked about today, the additional $4 billion? Has that already been targeted?
It has been, and what we talked about is actually the two areas that were already in our plans, Guyana, which is deep water resource development in the Permian. As we've worked, we've had more discoveries in Guyana. We had 2 discoveries this year, 5 discoveries last year, so that resource continues to grow, and so we're putting additional additional capital into that resource, discoveries that we've had since our last review last year. And then in the Permian, as we've delineated that acreage and as we've brought the broader Exxon Mobil advantages to bear there, we've come up with different development plans which lead to more CapEx and basically capturing that value much quicker than we had in the past.
Guys, I think the big question is how much they're doing for the long haul versus what some shareholders want to see right now. Again, if you are investing for the long haul with capital expenditures going to $30 billion this year and somewhere between $33 and $35 billion next year, you can say this is for long haul planning. This is what we want to do to raise production. And he has said that they are expecting to see production increase by about 5%. There are some who say they want to see more action on buybacks now. They'd like to see more information on that because relative to some of their peers like a Chevron, they haven't laid that out quite as clearly. But he did say with this $15 billion in divestitures, that's where they plan to get the money for the share buybacks.
Amazing how much they keep finding.
Yeah. With just the game, I think probably is now scale. If you're looking at the Permian Basin, Chevron has really loaded up too. And between Chevron and Exxon alone, they have an area about the size of Rhode Island, just in the Permian Basin, that they can now work with. And once you get to scale, if those properties are near each other, you can really do a lot more things than any of the small players can do.